So there's something called what we call the everything code dominoes. It's what drives what assets and when, and it's all phasing. So gold, financial conditions leads everything by about 9 months. Gold perfectly reflects financial conditions, as does dollar yen, as does silver. They're all in financial conditions land, so it's in the future. So they lead Bitcoin. And you can put the chart against it very nicely, and there's a very clear lead lag between gold and Bitcoin, because Bitcoin lives in somewhere around liquidity, global liquidity. Global liquidity leads it a bit by 3 months. So what you've got is a phasing. So when we talk about a rotation, it happens naturally. Like we're now seeing as the business cycle picks up, what happens when the business cycle picks up? Commodities go up. What's happening right now? Commodities are signaling the business cycle is going to go up. I think gold can still go further. I don't think it's clearly overdone, but I think it can go further. Can it correct, go sideways for a month or two, ease off a bit of the overbought because the RSI is like 97 or something stupid. But I still think it goes further because I think the dollar goes lower. And I think financial conditions have to be very easy to deal with the debt rollover and the interest payments on the debt. And gold follows that chart perfectly as well.
When most people look at financial markets, they see chaos. Prices jump around, narratives flip overnight, and it often feels like no one really knows what's driving anything. One week, it's inflation fears. The next, it's geopolitics. Then suddenly, everyone is talking about liquidity again. To the average investor, markets look emotional, noisy, and unpredictable. But according to Raoul Pal, that surface-level chaos hides something far more important underneath. Markets are not random. They move according to a sequence, a kind of internal clockwork that determines which assets move first, which follow later, and why leadership shifts the way it does. Raoul calls this framework the everything code dominoes, and it's the foundation of how he understands global markets. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
So there's something called what we call the everything code dominoes. It's what drives what assets and when, and it's all phasing. So gold, financial conditions leads everything by about 9 months. Gold perfectly reflects financial conditions, as does dollar yen, as does silver. They're all in financial conditions land, so it's in the future. So they lead Bitcoin. And you can put the chart against it very nicely, and there's a very clear lead lag between gold and Bitcoin, because Bitcoin lives in somewhere around liquidity, global liquidity. Global liquidity leads it a bit by 3 months. So what you've got is a phasing. So when we talk about a rotation, it happens naturally. Like we're now seeing as the business cycle picks up, what happens when the business cycle picks up? Commodities go up. What's happening right now? Commodities are signaling the business cycle is going to go up. That phasing is always prevalent in markets. It's always there. So when I see gold doing what it's doing, it's telling you financial conditions are easing massively. The biggest driver of financial conditions is the US dollar. The US dollar got absolutely murdered the last few days. We still expect it to go lower. That increases financial conditions. It tells us the length of the cycle because it lives 9 months further ahead than here. So it's like, well, the liquidity cycle can continue towards the end of next year now, September of next year. So everything seems to be playing out as it should be playing out. I don't know if you remember in 2020 over the pandemic, gold went first. I remember because I was buying gold and then ended up just switching everything into Bitcoin because Bitcoin becomes an outperforming asset because, gold can do a couple of 100%, crypto can do 5, 10x if you're lucky. So again, it's the patience thing. It's right. You've got the financial conditions that are showing us that liquidity is going to pick up. We've got gold confirming that. And now we're just waiting for crypto to do it. And we've seen NASDAQ following liquidity all the way perfectly. So I don't think there's anything wrong. I think we had a temporary aberration because of what happened in 1010 in crypto, and that'll clear out the way and we'll have forgotten all about it in 6 months' time. I think gold can still go further. I don't think it's clearly overdone, but I think it can go further. Can it correct, go sideways for a month or two, ease off a bit of the overbought because the RSI is like 97 or something stupid. But I still think it goes further because I think the dollar goes lower. And I think financial conditions have to be very easy to deal with the debt rollover and the interest payments on the debt. And gold follows that chart perfectly as well. Again, there's a whole kind of flow of how this all fits. So yes, I think it goes further. Silver, don't know, possibly, but we're obviously wildly overbought now. Generally speaking, it should go on a little bit longer. Whether it's another 2 or 3 months, don't know. So I'm not really one calling a gold top. Would I buy it here? No. The risk reward is not good enough to buy. So at a top level, yes, central banks want to be less reliant on dollar assets, but not massively so because they all need dollars. 87% of the world trade is in dollars. Over 50% of world debt is in dollars. So the dollar ain't going away. There's nothing they can do about it. They can't do it. If the Saudis want to hold less dollars, it's difficult because they get paid in oil in dollars, and they're huge investors. So what happens every time is when you're at this point in the cycle is the dollar weakens. It's driven by the business cycle. So the dollar weakens. So you are sovereign wealth fund in Abu Dhabi. What do you do at this point in the cycle? You diversify out of dollars. Well, Abu Dhabi's less good an example, but no, I guess it works still because you find that other assets, emerging markets do well, stuff like that. If you've got a more variable currency, you tend to buy something like gold because that gives you the basis to avoid the weak currency and offset your strong currency. Because if your emerging market currency goes up, you export less, all of that. So it's a natural function, it happens every time. And every time says, oh my God, the central banks are all buying. Yes, because that's their job. Their job is to protect their sovereign wealth. And if the dollar's falling and many of their assets in dollars, they will always make sure that they increase their allocation to gold at this time. They don't tend to reduce it much. And the reason being is over time, the wealth of nations grows. So they don't need to reduce it. It just becomes an asset. But yes, the Russia thing changed it for people. And yes, the marginal propensity is to not be beholden to the US the best you can. And that's where, speaking to many sovereign wealth funds, that's where Bitcoin's coming in as well. So let's say today, China has a quantum computer. What do they do with that? Where's the highest prize? Is it to hack Bitcoin and everybody sees immediately that there's been a quantum hack of Bitcoin and Bitcoin goes to zero? None of the money, they won't make any money from it because the prices would fall immediately. Where's the biggest prize? Well, it's the US defense system, the European defense system, Google, Facebook. I mean, the entire system is based on that SHA-256 encryption. We're going to have to change all of these things. So if quantum was the risk, then Google's share price will be falling. The US government would be in blind panic. So I don't believe that to be the case. But do we take it seriously? We need to. Ethereum's moving that way, Sui's moving that way, I'm sure Solana are, and finally the Bitcoin devs are starting to wake up and realize that you're going to have to do something. But Bitcoin is always slow to move, takes a lot of debate. But, we don't want to lose all the old tokens because it's not the new wallets that matter, it's the old ones where you've got the quantum problem. So I think game theory would suggest crypto's the last place that they'd start because there's not going to be some guy in his garage. It has to be a nation state, really, or a giant tech company to have a quantum computer that's able to do this. And where would they put it first? Because if not, you make the announcement to the world, we've got quantum computing. And you would attack Bitcoin first? No, you'd attack all of the defense, all of the everything else, and then you might try and scoop a bit of Bitcoin if you can before it goes to zero.
While Pal remains bullish on gold, he is clear-eyed about near-term risks. Gold is extremely overbought by traditional technical measures. A correction or consolidation would be entirely normal and even healthy. But overbought does not mean finished. The structural drivers remain intact. A weakening dollar, rising debt rollover costs, and the political necessity of easier financial conditions all support higher gold prices over time. Silver may follow, but it tends to be more volatile and less reliable as a signal.
So I think a network is more adaptive than the financial system. The financial system is fragmented, complicated, out of date. To try and coordinate every bank of every major country to entirely change the encryption systems, I think is near impossible. Well, it's not impossible, but it just takes a lot longer than really getting a bunch of people to. We're seeing with Ethereum now, they're now starting to work on the quantum proofing. It'll be a much faster process than the banks could do. The banks would be years to do this. I mean, it took them long enough with Y2K, and that was much less of a risk. So yes, I'm still very bullish on Q1. And it's going to be a big test of my hypothesis that the liquidity conditions are coming over this Q1 period. But, we've seen the changes to the bank regulations, the eSLR, which means that the Treasury can directly monetize debt by selling it to the banks. That increases liquidity in the overall system. We've got a potential partial shutdown of the government still to get out of the way. So we've got that. But so they haven't been drawing down the TGA, the Treasury General Account. But that's likely to start happening as well. We're likely to start to see signals about the change of who's going to be the Fed chairman. And, if you see Rick Reeder, he's talking about interest rates are 100 basis points too high. So we've got a lot of liquidity conditions along with fiscal stimulus all coming in Q1. Because don't forget, the game here is for the Republicans to win the midterms. And they're going to try and juice the economy as much as possible. So we should see the ISM, the business cycle, starting to rise as well. So from everything I look at, it suggests that liquidity is coming into the system. The main liquidity source currently is the Chinese. So they've been using their balance sheet. Liquidity is starting to expand. The weaker dollar is one of the biggest indicators of liquidity as well. So for me, it's all here. It's just a matter of waiting for a catalyst of which to take this all off. Because I think the market is currently trading at a discount to liquidity conditions. And at a reasonably significant discount. So, if you were to close the gap versus liquidity, Bitcoin should be where we are today. We're around 90,000 as ever, doesn't move. It should be sort of 140,000. So we use financial conditions, which leads by 9 months ISM. Then 3 months behind that is global liquidity. And eventually you get to ISM. So we use probably, several hundred forward-looking forecasting indicators for ISM. And they're all suggesting ISM comes strong this year. Then we can double-check that against what Scott Bessent's saying. And Scott Bessent is saying, we really need to stimulate Main Street, not Wall Street. And stimulating Main Street is about bringing lending back and confidence back. So fiscal stimulus helps. It gives people more money to spend. They've got huge kind of tax depreciations on fixed asset investment. Remember, we've got this massive capex boom to come. We're going to be building data centers and power generation across the United States. So that's going to generate jobs. They're going to try and get mortgage rates lower, which generates more free income for people to invest, take risk, do these things. These tend to increase the ISM survey. Additionally, the changes to the eSLR means that banks are free to lend more, so they can use more leverage on their government bonds. So that lending has been restricted really to Main Street companies. It's not been easy to borrow money. So that allows for the free flowing of money. So you've got a number of factors that all suggest that the business cycle should pick up. And again, Scott Bessent's telling you they want to close the gap of the K-shaped economy. What is the K-shaped economy? It's markets versus the ISM. And what we've seen is technology and even crypto, if you take it back, have outperformed while the economy has been extraordinarily flat. So they're going to win an election. Don't forget, the Trump base is middle America, the disenfranchised middle American. And if they want to get voted back in, they're going to have to prove they've done something. So I think it's all set up for this to be very strong for the ISM. I'm looking at like the hourly chart because you can see it. We've only had 1 or 2 of these this year, but we were having it every single day before. So I think it's gone. I think it's gone for now. But people are still licking their wounds. There's less capital in the market. And, gold and silver had a big run. Tech stocks have had a big run. So speculative capital moves for the place with the fastest rate of return. And so speculative capital hasn't come back in here yet. And that kind of makes sense to me. It just takes a while to repair. I looked at the bear market lows in 2022 after that final leg down. Again, remarkably similar to now. It takes a digestion period, and that digestion period's not a few days. It's basically, a couple of months or longer. And I think we're just doing that. On crypto Twitter, everybody wants to go to some nefarious actors. I would put it the other way around. They probably didn't want this to happen, and they had to do something. If indeed that is what happened, regulation. Well, we're still waiting for the stability app, the market structure. We still don't have this in place, so we're still a bit in the Wild West. And, all global exchanges, if they want to operate within the United States or in Europe, will end up with having some forms of regulations. So I think over time they get more regulated, and that's fine. But there will also be these small ones that are unregulated. Crypto is still the Wild West. It's a decentralized, financial market of which, who knows what can happen.
I think it further shows the need for the rise of perp dexes and decentralized exchanges.
Yes, but they can still have issues where things go wrong, right? You can have just because you think it's all run by a smart contract doesn't mean things can't go wrong.
Raoul Pal's message is not one of blind optimism, nor of short-term prediction. It is a reminder that markets move in phases, guided by liquidity, financial conditions, and human incentives. Gold has spoken. The dollar has confirmed. Liquidity is expanding. The business cycle is turning. Crypto has not yet responded, but history suggests that when it does, it will not do so quietly.